class, welcome back. I'm Matt Fisher, I'm your accounting professor. In today's video, we're going to go over plant assets, and we're going to look at the introduction to this, because the next several videos go over lots of different concepts associated with plant assets. So first of all, what are plant assets? Well, most textbooks have this broken down into four major types. The first one being land. Land includes the cost that we pay for the land, plus such things as the commissions, delinquent property taxes, legal fees, title insurance. All these costs that are accumulated when we purchase land all go into that land account. They all get accumulated into that one account. What's important to know about land is that it is not depreciated. We put it on our books at that value, and that's how it stays until that land is later sold. All right, the next type of asset we want to talk about, plant asset we want to talk about, is land improvements. Land improvements are such things as parking lots, lighting, fences, etc. These are things that are kind of on the land, right? So a lot of times people are thinking, oh, these are land. No, we call these land improvements. They're different than the land because they depreciate. So we need to have them separate because we're going to depreciate these items, whereas land, we don't depreciate. Now, the next item is machinery and equipment. This includes the cost of these assets, plus all the costs to get these assets to our place of business and ready for their intended use. All right, so this would include such things as sales tax, shipping costs, installation costs. If we have to install some machinery, those installation costs, all the costs that we need to get this up and running go into that equipment or machinery account. And then that total amount will be what is depreciated for that asset or used to calculate the depreciation for that asset. The last item we're going to talk about are buildings. Buildings include the purchase price, title fees, commissions, brokerage fees, things like that. When we're purchasing a building, all those costs associated with the actual building itself, the purchase of that building, go into that. And then these costs are then depreciated based off of the different depreciation models that we're going to be looking at. Right? If we're building or constructing this building, then the cost to build, design fees, permits, utilities during construction, all these costs are accumulated as we're building this. And then when we're done, all those costs are the cost of the building. And that's what would be used in our depreciation calculation. Now, in upcoming videos, we're going to go through different depreciation models. All right. And then let me also point out that I'm calling these plant assets, but every textbook and every business, might call it something a little bit different. Some other names are fixed assets, property, plant and equipment, machinery and equipment, things like that. So it's not just one name, it's not just plant assets. But I like to just use that one general term because it seems like most textbooks like to call it the plant assets. All right. Now, the next part is depreciation. Now, certain assets, like I said, land improvements, buildings, machinery and equipment, all these type of assets, they decrease in value, they depreciate. All right, and so we're going to be going over that calculation a little bit later in the next few videos. So when we purchase an asset, here's an example. When we purchased an asset, which is equipment in my example, for $105,000, and this price includes the price, the shipping cost, the installation, all those costs to get this equipment to our place of business and up and running were $105,000. So we debit the equipment, and then we credit either cash if we actually paid for it right now, or we would credit a note payable, meaning that we owe somebody that money. Right. The last thing I want to talk about now are intangible assets and natural resources. Intangible assets I like to think of as like legal rights. Right? You can't touch them. They're legal rights. Well, these assets also decrease in value. Sometimes it depends on which asset. But these are such things as patents, copyrights, trademarks, goodwills, franchising agreements, and they're technically not depreciated, but we call them being amortized. So If by our rules they are able to decrease in value, then we would amortize these items. Now, what about natural resources? If we have natural resources such as timber, coal, oil, ore, okay, these are natural resources, and they also can be reduced in value if we have this natural resource. We don't call that depreciation, we call it depletion, right? And the method that we usually use for this is called the units of production method, right? For depleting natural resources. And we will go over that method a little bit later. All right, class, I hope this has helped out. This is just the introduction to plant assets. And now in the next few videos, we'll go over some different topics that go along with plant assets. All right, hope to see you in those videos.